Hi everyone, this is Mark with Ease Investing. Are you ready for the most complete video that there is on YouTube about buying a call option? Watch the video till the end and you'll never forget what buying a call option is, and you'll know about the important things to look for when buying a call option. Let's get into this video. What is buying a call option and why do investors buy call options? Why is this important for you? Buying a call option, simply put, means that you are betting the stock price is going to increase on the stock in a certain amount of time. If the stock price increases in that certain amount of time, you make money. If it does not, or if it decreases, you lose money. Investors buy calls because they believe that the stock price is going to increase in a certain amount of time. And the reason why this is important for you to know is because you can make a lot of money by knowing what buying a call is. In this example, we're going to use the stock Nubank, ticker symbol NU. We can see that the stock is currently trading at $14.78. Before I proceed with this video, I want to go over a couple of very important things before buying a call option. Number one, I only buy a call option on a stock that I want to own that has great fundamentals. And number two, I only buy a call option if the stock is currently trading at a share price I am comfortable owning the stock. So in this example, if Nubank didn't meet my criteria for a stock that I want to own with excellent fundamentals, I would not sell a call option on it. And number two, if Nubank was trading at, let's say, $100 and I didn't want to own the stock for $100 a share, I would not buy a call on the stock. So make sure before buying a call that it's a stock you already want to own with excellent fundamentals and that it's currently trading at a price you are comfortable owning it. Following those two rules will keep you out of a lot of trouble. So let's get into buying a call. In Robinhood, you'll click Trade, you'll click Trade Options, and you'll select your expiration date. Whenever I buy a call, I like an expiration date that is more than a year out. This is also known as buying a leap, L-E-A-P. So whenever you buy a call that is more than a year out with the expiration date, that is the same thing as buying a leap. In this example, I'm going to select December 17th, 2027. Make sure that you have buy and call selected there at the top. We can see that Nubank's currently trading at $14.78. The call I'm going to focus on in this video is the $17 call. We can see that one contract cost us $3.50. Remember that each contract is 100 shares. So you are going to be paying $3.50 per share. In other words, this contract is going to cost $350. This is a big difference because you are controlling 100 shares of Nubank for $350. Instead of if you bought 100 shares at the current share price of $14.78, that would cost you $1,478. This is one very important reason why investors buy a call. It's because it is a lot cheaper to control those 100 shares than just paying for the stock at the current share price. But remember, one very important point is when you buy the shares, those shares never expire. When you buy a call, it has an expiration date. In this case, it expires December 17th, 2027. Let's go ahead and click on the $17 call, and I'll explain the important numbers that I look at. One thing before I click on the $17 call, remember that $3.50 because that's going to come in handy when I'm doing my explanations. Let's go ahead and click on the $17 call. What do I look at on the screen? First of all, this screen can be intimidating when you first look at it, but I'm going to explain it to you in a very simple way so that A, you understand it, and B, you know what you're looking at. Please like and subscribe if this video is providing value to you. The first thing I look at are the Greeks. We can see that there are 5 Greeks. Really, when I am buying a call, the only Greek I look at is the delta. The delta tells me and tells you 2 things. The first thing that it tells us is how much the contract price is going to move up or down depending on each dollar movement of the stock price. Let's just go back real quick and remember that the share price is $14.78. So if the share price were to go from $14.78 to $15.78, the contract price, which was, do you remember, the $3.50, that means if the share price went up by $1, instead of that contract price being worth $3.50, that contract price will now be worth $4.08. So that would mean that you would make money because the contract price increased in value. Now let's go back and let's say the share price went from, let's say you bought this for $3.50 and the share price went down $1 to $13.78. This would mean that the contract price would move down by 58 cents. So instead of the contract price being worth $3.50, that contract price would now be worth $2.92. So you would lose money. That is the first reason why the delta is important, is it tells you how much money you are going to make or lose by each dollar movement in share price. The second thing that the delta tells us is the percentage that Nubank will be at $17 by December 17th, 2027. This delta is telling us that we have a 58% chance that Nubank stock price will be at $17 by December 17th, 2027. Those are the 2 things that the delta tells us. So that's the Greek that I look at. The other numbers that I look at are my chance of profit. Remember that I paid $3.50 for the contract. So $3.50 plus 17 equals what? That equals $20.50. The chance of profit is saying I have a 24% chance that Nubank will be at $20.50 by December 17, 2027. The other 2 numbers that I look at are the volume and open interest. I like the volume to be greater than 100, and I like the open interest to be greater than 200. The reason why is because if I wanted to close this contract early, the higher the volume and the higher the open interest means the easier it is going to be for me to close this contract early. Remember, I bought a call. So if I wanted to close this contract early, I would need to sell the call. If the volume and open interest were both 0, I'd be unable to sell this call early. And I'd have to wait until the expiration date, December 17th, 2027, before I could close this contract early, or I could sell this call to close the contract early. That is why the volume and open interest are important, is because it tells you how liquid this contract is and how easy it is going to be to sell the contract early. And remember, you would sell it because you bought the call. So you would sell the call to close it early. The last thing I look at is the IV, the implied volatility. When I am buying a call, I like the implied volatility to be less than 40%. The reason why is because the higher the implied volatility, the more money I'm going to be paying for the contract. And the less that the implied volatility is, the less money I'm going to be paying for the contract. Generally speaking, if the implied volatility is greater than 40, this contract is going to be considered expensive. And if it's less than 40, it's not going to be considered expensive. Those are what I look at when I am buying a call. The last thing we're going to get into are the technicals. So let's go back. To access the technicals, you're going to click Advanced. The technicals that I look at when I am buying a call are the Bollinger Band. To access the Bollinger Band, you would click the F button and you'd make sure that Bollinger Band is selected, which we can see here it is selected. Remember, the stock price, which is here in green, likes to trade within the Bollinger Band. We can see currently it is trading about in the middle of the Bollinger Band. So we can see that the stock, the share price, is within the Bollinger Band. If it was at the bottom of the Bollinger Band, it'd be considered cheap. And if the share price were at the top of the Bollinger Band, it'd be considered expensive. So generally speaking, when I'm buying a call, when I'm looking at the Bollinger Band, I like to buy a call that's at the bottom of the Bollinger Band. The next thing I look at is my moving average. When I buy a call, I like the share price to be above the moving average. We could see that the share price is above the 200-day moving average. The moving average is important because it acts as a support level for the stock, meaning if the share price were to go down and hit that moving average, it would almost act like a trampoline and technically shoot the price up. Obviously not always the case, but I do like to have that support, and I like the share price to be above the moving average. And the last technical I like to look at is the RSI. Watch my other videos if you don't know what the RSI is, but basically if the RSI is above 60, the stock's considered expensive, and if the RSI is below 30, the stock is considered not expensive. So you want to buy a stock when the RSI is closer to 30. We can see that currently the stock is at 60, so according to the RSI, it's considered to be expensive. Those are how you access those technicals, and those are the 3 technicals I look at when I buy a call. I hope that this video has provided value to you. You now understand what buying a call is. You understand what to look at when you're buying a call, and you understand the technicals when buying a call. Remember though, the 2 rules are very important, that those are satisfied before buying a call. That it's a stock you already want to own with excellent fundamentals, and the share price is currently at a level that you are comfortable paying.